S&P 500 Complete is your go-to for regular updates on all 500 stocks. Subscribe so you never miss out. Let's jump in. Consolidated Edison, ticker ED, just beat Q1 2025 earnings, with revenue jumping 12% year-over-year to $4.8 billion. While everyone's worried about utilities, ED is sitting on a $72 billion infrastructure investment plan that could drive serious growth. Here's why Consolidated Edison might be the most undervalued utility play right now. First, the dividend story is incredible. We're talking 53 consecutive years of dividend increases with a 3.3% yield. That's over half a century of raising payments to shareholders. With a 63% payout ratio, there's plenty of room for both dividend growth and reinvestment. Second, regulatory support is massive. Consolidated Edison just got approved for base revenues, growing from $9.8 billion in 2025 to $11 billion by 2028. That's guaranteed rate base growth of 3 to 5% annually. In the utility world, that's basically a license to print money. Third, the electrification boom in New York City. With EVs and electric heating exploding, Consolidated Edison controls the monopoly delivering power to the densest, wealthiest market in America. Peak load growth is accelerating, and they capture every single kilowatt. Fourth, the valuation disconnect. This company trades at 19 times forward earnings, below its 10-year average of 20 times. Analysts have a consensus price target between $115 and $130. That's potential upside of 19 to 24% from current levels. Fifth, management is executing perfectly. They just beat Q1 consensus EPS by 3%. And reaffirmed full-year guidance of 5.502, 5.70 per share. CEO Tim Calley raised $1.3 billion in equity to fund growth without stressing the balance sheet. Now, I have to be honest, there is one major concern that has me watching closely. Free cash flow plunged to negative $1.63 billion in 2024. That's a 236% decline from positive $1.2 billion the year before. Moody's just downgraded their credit rating, citing cash flow weakness, and debt has ballooned to $27.8 billion. If this cash burn continues, they might need to cut dividends or massively dilute shareholders with equity raises. So that's the quick breakdown. What do you think? Are you bullish on Consolidated Edison's infrastructure growth story or worried about that cash flow? For the complete deep dive analysis with all the financials, drop a comment below.